The following was recorded in front of a live studio audience at the Studio 21 Podcast Café. This is the United Podcast Network.
Welcome to the Stock Market Authority Podcast. I'm Bakes, Kevin Baker. I'm going to teach you how to make money in up and down markets. Very few podcasters or coaches cover this. I'll show you how to lock in profits and minimize losses to make you a better investor. So once a week, you're going to know what's going on in the world and the stock market. Welcome to the Stock Market Authority Podcast. Morning, folks. Happy Wednesday, and welcome back to Bakesics, our second part in our series where we talk about what's really important in financial statements and what to look for. I want to recap a little bit that we're talking now about loosely AMN Healthcare, a buy that we had back in 2013 at 1268. Eventually went to 40 when I left the firm, and now it's at 105. So this clearly works. I go charts first and fundamentals second. I think that's the way to go, just for time management alone. Learn how to ask open-ended questions and then shut up when you're when you're talking to CEOs, CFOs, and have your 5 to 10 reasons why you buy something, and as those fall apart, have reasons to sell. So let's get right into financial statements. And the way I set it up, I had a FactSet system, and I like to see things serially. I want to see trends. So, for example, sales obviously is the most important. Revenue, the top line, they're all synonyms. And I wanted to see how that progressed over recent quarters. I used to use 2 years of quarters. And of course, what I wanted to see was percentage growth in sales, and I wanted to see it accelerating. If sales were growing 8%, I wanted to see them go to 20 in the case of AHS. So if you have the ability to have a system that computes that, so you can see it visually and see that percentage growth rate go up, I think that's tremendously helpful. And then I'd go through the rest of the income statement, and in particular, I wanted to see net margins increase. So you have revenues, you have expenses, you have taxes and all that good stuff, bad stuff. But you have net income, which then goes to earnings when you divide by the number of shares. But I always wanted to see revenue growth with margin expansion, because that's the way you can really see the bottom line number, the earnings number, explode. And when you're in front of those things before other people pick up on it, which has gotten very, very difficult over the last 10 years in this era of algorithms and computers and automation and what have you. But in the case of AMN, we saw revenue growth accelerating, margins expanding as the locum tenens business, the physician placement, temporary placement business turned around. So revenues went positive, margins went up, and the nurse business got better because of Obamacare, and then you saw earnings really start to accelerate. And there's a lot of people out there that when they start seeing earnings growth accelerate on a year-over-year basis from 20 to 30 to 40, they get really excited. And frankly, I do too. So the chart suggested that things were going better. The income statement was certainly showing that as we go from 72 cents in earning to the $1 that it eventually became in 2014. Next is the cash flow statement. And my main focus here was I wanted to see free cash flow growing, at least steady, but hopefully growing. So in this case, they could pay down debt more rapidly than people thought. That was trading. That was a 5 3/4 coupon, but they were paying it down faster because free cash flow, which is operating cash flow, the top third of the cash flow statements minus CapEx, and then see how that grows. And especially FactSet did a wonderful job of. They're not paying me for this, and they don't need me. I'd love to have them sponsor us. You want to see the cash that comes in the door growing substantially. And that's a really great confirmation that earnings are justified and are clean, so to speak, and are driving the business going forward organically without financing needs. So that's operating cash flow. Then the balance sheet. And here, what I really wanted to see was just debt declining. I wanted to see solid coverage of their interest expense, but I just wanted to see debt coming down steadily. And pretty easy to see. Nowadays, I'm sure there's 1,000 systems that do this, but I want to see debt at a reasonable level. I want to see the interest coverage be 3x at least, and I want to see that number coming down. And if it's not, you get to ask some really hard questions of the CEO and CFO and find out what that is. I'm going to go into some more of the financials, but let's take a quick break.
Do you want to become a better investor? Do you want to learn how to make money in both up and down markets? Then you need to go to stockmarketauthority.com and sign up for our free newsletter today. Stock Market Authority is run by award-winning investment manager Kevin Bakes Baker. His aim is to save you time while teaching you how to be a better investor. Bakes saves you time by diving into all the latest stock market news and information so that you don't have to. He reads all the latest articles, analyzes the charts, and listens to all the relevant podcasts. And then once a week, he gives you a breakdown of what's happening in the market. Stock Market Authority is constantly outperforming the S&P and the HFRX. Bakes is going to share with you his weekly stock observations. He'll give you concise insights and show you how to lock in profits and minimize losses. Stock Market Authority is making money in up and down markets. Wouldn't you like to do the same? So join now and let Bakes show you how. Head on over to stockmarketauthority.com and sign up for our free newsletter today. That's stockmarketauthority.com, making money in up and down markets.
And we're back. Let's go through a few more things on the financial statements, and then we'll wrap up. This is kind of memory lane for me. I did this so many times, but I'm pulling this out of the archives a little bit here. But I would really march into all these meetings, and I'd have this sheet here, and it'd be like, the CEO and CFO would kind of be surprised, like, wait a minute, I wasn't ready for all of this. But things that I learned over time that really, really mattered: DSOs, days sales outstanding. Frankly, are they turning revenues into cash? Are they getting paid? And especially, is that getting better or worse? And if you can see it, lined up left to right, that it's getting better all the time, that always gave me confirmation. Now, you never see a company with all of these things absolutely perfect. It just doesn't happen. But you want to make sure that there aren't fatal mistakes that are relatively obvious that can bite you. And so you can't just take at face value, here's our guidance and we're off to the races. You want to make sure that they're getting paid and the DSOs are going down. And I always found that was helpful. I always wanted the current ratio to be 2+. Wasn't hard and fast, but so that means current assets minus current liabilities, that the balance sheet was solid and the company was not over leveraged and they didn't have to rely on external financing. Return on equity, is just table stakes, frankly. And the higher the better, and especially if it's going north. The net income over the book value, the equity, I wanted to see that going north, and those are hard things to fudge, especially trends. So you want to see that the capital that they've deployed is generating substantial returns, and so I would look at that as well. I talked about this before, but operating cash flow, CapEx, free cash flow, and just see if those are deteriorating, why they're deteriorating and why they're going to change, and make sure you like the answer that you get. A little bit of a subtlety. I always used to like to ask a question of, if I had the CEO and CFO in the room, and this is kind of fun when you talk to couples as well, I'd ask a question, but make sure I had one eye on the other person to see, are they fidgeting in their chair? Did they roll their eyes? Did they cough a little too much? Are there things that suggest that there's discord or dissonance versus congruent responses to all these questions? That's it for the financial statement component. Please go to stockmarketauthority.com, sign up for my free newsletter. I talk about a lot of these things over the course of the week in between the Wednesday podcast. I hope this is helpful. Please go to Bakes at stockmarketauthority.com. Give me your feedback. Tell me what you liked, what you didn't like, what I should add, and I will see you really soon. Thanks a lot. Keep smiling. Bye now.
The views and opinions expressed by the hosts, guests, or callers of this program do not necessarily reflect the opinions of the Studio 21, Podcast Café, the United Podcast Network, its partners, or affiliates.